Traders, using this strategy and trading framework, I went from 10 years of losing constantly to having multiple six figures in profits, hundreds of clients doing the same, scaling my own accounts, passing Propfirm challenges, all because of this framework and strategy. And in this video, I'm going to break down the strategy itself, the framework, how to think around it, and how I did it all without staring at charts, because I use a 3-step process that involves data and statistics and probabilities without any discretion, which means I'm not relying on my skill set to trade. I'm going by the data. Data is black and white. Data does not lie. So let's get right into the video. So let's break down the 3-step process, the framework behind me having my trading breakthrough, behind me losing for years and years and years trading as a manual trader to then switching to a data-driven approach and trading it algorithmically. Now, when people think algorithmic trading, they think you have to code or come up with complex ideas and complex skills. That was the case in the past. However, with the advancements of things like machine learning and data mining software, we can create strategies using a 3-step process without having to learn code, as long as you know the process. And I'm going to run it down in this video. This works on Propfirm accounts. This works on your own personal accounts. And it's not only worked for myself, it's worked for hundreds of clients as well, taking them from basically losing to winning. So I'm going to break down each and every one of these steps sequentially. So let me just make myself a little bit smaller so you can see here. And it all starts with data mining. So previously, when you used to have to create an algo strategy, you used to have to come up with an idea. You used to have to think of an idea and then code that idea and then test it. It was long, it was laborious. I used to do it myself. Now we use something called data mining. Essentially, it's where you pull in lots of data from brokers. Let's say you're with IC Markets or DarwinX. You pull in 10 years worth of data. So every single tick of data that happened on a certain asset over the whole trading period. And you start off with raw market data. And you give the system parameters. What I mean by that is you let the system come up with the ideas for the trade itself, as long as it falls in line with your parameters. Let's say you want to test a breakout strategy, and you give the system certain parameters of a breakout strategy. For example, once price goes above or below a certain range, we enter into a long position. And we want to find strategies that have at least an X amount per year annual return, at least a Y amount of drawdown, and it has to have a profit factor of 1.5. Let's say those are the only 3 criteria that you've defined to data mine. You give the machine that information and it works on hyperspeed to be able to come up with lots of different combinations of a breakout strategy. And that's the first step of the funnel. We start wide, and it's basically the pattern, rule, and discovery stage, or we're giving the machine logic to enter a position. The next step is genetic evolution, which basically means, if you think of Darwin's theory of evolution, we started out as little organisms, then we went into apes, and then we turned into man. We got better and better over time, although some people would say we haven't got better, but we got better and better over time. We evolved. So that's exactly the same thing that happens in the genetic evolution or DNA stage. So let's just say with the parameters, the machine's learning, it's found a strategy, a breakout strategy that uses a range breakout. Then the genetic evolution stage would find lots of different versions of that range breakout, different parameters, different settings to try and continue to improve it. And then it keeps going down and down and down until it can't anymore, and then you move on to another strategy. So that's the sort of data mining process. And how I always like to describe it is, imagine a cook on a cooking show where chefs make random dishes. The tastiest ones hybridize. So your sauce plus my seasoning, and over generations and recipes just get better and better and tastier and tastier. So that's the first start of basically data mining strategies, is coming up with a big pool of potential strategies that are profitable and fall in line with the parameters that you've defined. And everyone's different because different rules are important to different people. Some people are really risky, some people are really conservative, and this is where you define all of that criteria and you put it into a big melting pot. And rather than you come up with a strategy, you let data dictate what strategy fits in line with your parameters that are important to you. So then you have a bunch of candidate strategies, which is where most in the algo trading space sell their algos. You've probably seen lots of algorithms being sold or bots being sold. and they show you a nice, pretty linear equity curve, 100% per month, every single month. It looks perfect, and everyone gets excited. They buy it, and it crashes. Because most people sell their algorithms at this stage, the back test stage. So everything up until this point in the 3-step process has just been a back test on raw data. The next step is what we call the robustness testing stage. And we're trying to break the strategy. We're doing as much as possible to break the strategy. So the best example I can give you for robustness testing is, imagine you have invented that recipe, but it only works if you cook it at your exact oven in your house using your exact pan. That's obviously not good, because all the other chefs can't follow the recipe because it only works in that specific environment. And that's the problem with using data mining to create strategies, is it's called overfitting. It overfits to the current market condition. An example in trading I like to give is, let's say that you developed a short strategy in the 2008 time when everything was selling off, the market was crashing, and your short-based strategy was absolutely crushing it because in that specific market environment, everything was selling off. The next year, you try to deploy your short strategy when the market was rebounding, everything was going long, it didn't work. So that's an example of it works in the perfect environment, but not in all environments. So what we do in this test, in this stage of data mining, is we come up with all of these strategies that we have, candidates, let's say there are 1,000 of them, and we break them. We try to break them as many ways as possible. And 2 of those ways is Monte Carlo testing and systems parameters testing. So in this stage, what we do is we run lots of random simulations. An example of a simulation, a Monte Carlo simulation, is, let's say that we have 1,000 trades in a back test, and the original back test is very profitable. Let's reorder or reshuffle the order in those trades happened. So rather than a sequence of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, we randomly shuffle them around. Is the profit factor, is the drawdown, does the back test now look the same in terms of profitability, or is it just completely skewed? Why this is important, because sometimes we have certain periods of time where it's really, or the profitability of a strategy is determined by the sequence of the trades. So by shuffling them around and reordering them, if we still have a profitable trade, a profitable backtest at the end of it, that's a good indication. Or another one is completely skipping trades. So maybe the backtest result, maybe the profit came from 10 trades out of 1,000, and those 10 trades pretty much made the strategy. If we randomly remove trades, is the backtest still profitable? So that's an example of Monte Carlo analysis and how we try to break the strategy. And we do that thousands and thousands of times with lots of different parameters. And at the end of it, your 1,000 strategies may be whittled down to maybe a handful. Another example of a stress test that we run is something called systems parameters analysis. That's basically trying to figure out if the meat and potatoes behind the strategy, if the indicators you use, for example, if they are the reason the strategy worked really well. And if you alter them slightly, then if it breaks, it's not a good strategy. And I'll give you an example. Let's say you have a simple moving average strategy using a 20-period moving average. Now, there's not much difference between a 21-period moving average or a 19-period moving average to the 20. It's very slight deviation. But if your strategy absolutely tanks it using a 21 period or a 19 period, it means it's overfitted to that one indicator, that 20 period, so it's not good enough. And again, that's an example, and we have lots of different tests that we run automatically in our process to be able to determine if the strategy is overfitted to the parameters it used. And personally, in our coaching program, we use a 17-step process and an automated process to be able to basically try to break these strategies and mimic real-world environments. And the last stage, once we have our initial pool of strategies here, maybe it was 1,000, then we whittled them down to maybe 100, or even less than that normally. Next is, how do we combine those strategies? Because the way that we like to trade in our program is completely diverse portfolio. So my biggest breakthrough as a trader happened when I stopped trading manually and started trading algorithmically. My real breakthrough happened when I traded algorithmically, but in a portfolio. So I wasn't relying on 1 or 2 strategies or 1 or 2 assets. Because guess what? Everything works until it doesn't. So Ray Dalio in his book always talks about the fact that his all-weather-proof portfolio is holding some cash, having some index, having some ETFs, having some precious metals, a diverse portfolio. And we are exactly the same. Not only do we have lots of different assets, we're long and short on the same asset. We have range assets, we have short assets, we have mean reversion assets, strategies. So basically we have all these different diverse strategies, so we're not reliant on one, because everything works until it doesn't. I'm pretty sure a lot of you listening to this video right now have had strategies in the past that worked really, really well for months and then just completely stopped working. That is why we use a diverse portfolio. And in this stage, we basically take the 100 strategies that we have left from our pool of 1,000 and we measure the correlation. We make sure that we have a diverse, uncorrelated portfolio that historically have worked well together and have complemented each other. An example of that, for example, if you run a restaurant, you don't want all of your customers arriving at breakfast and nobody at dinner, because you want to flow throughout the day, and diversifying strategies spreads your risk. So for example, if out of those 100 strategies, if 99 of them were short index-based strategies, if an index goes up, but all your portfolio is short, you're going to have too much exposure. So historically, we want a good mix of strategies that work well together. So when one's in drawdown, the other one's up. When one's flat, the other one's winning. So, and again, you can only do that when you base everything on data. When you look at data, which is fact, and not on discretion, which is what you think you see in front of you, that's when you can have a data-driven approach. So to summarize, we let data tell us what strategies are profitable. Then we try to break those strategies as much as possible, and then we see which strategies performed well together, and that is a portfolio. And just to give you an example, a typical portfolio for me and for most of our clients is about 20 to 30 strategies, and it has a mix of precious metal, indexes, and currencies. And that mix hedges us, and that is what allows us to basically be consistent in the market. So if you found today useful, if you want some more information about how we trade profitably, there's a link in the description. You can go and watch a short 5-minute case study. If you have any questions, let us know below and I'll be sure to answer them. Apart from that, happy trading. Catch you soon.